So outside of disposal events, and the next element that we have to consider is, are these taxable gains or taxable losses? Okay, so you make the gain of $300 there as a disposal, but it's oftentimes not that simple. You know, you might have gone from Bitcoin to Ethereum to Litecoin to Dash, back to Bitcoin, some dollars back into Bitcoin, you know, name it. You can get going on and on. Or maybe I bought Bitcoin, bought some different Bitcoin on another day, bought different Bitcoin on another day, bought some different Bitcoin on another day. You know, so you can have this, you know, stack worth of different acquisitions that happened from various different events. Okay, so the key sort of here is to work out, okay, how do you go through this and work out your gains and losses? If there's little events that are happening, you know, you can work your way through this. But when there's a lot of events, that's when you want to use some sort of automation software to help out. As part of this course, we will run through some of that record keeping. But I suppose the main point I want to make is, you know, let's say you bought Bitcoin at 3 different times, and then you have disposal. So I bought half a Bitcoin, I bought a quarter of a Bitcoin, and then I bought 1/10 of a Bitcoin. And then later on, I got rid of, say, 0.2 of a Bitcoin. So not all of my Bitcoin is gone. How do I work out which cost to allocate against one of my disposals, or the 0.2 Bitcoin? The tax law is sort of, you know, it's reasonably flexible at this stage. It sort of technically says, look, if you can follow the exact Bitcoin back to an acquisition, you have to apply that. So I might have bought 1 Bitcoin and I put it over in this wallet over here. I bought 2 Bitcoin and I put it over in this wallet over here, and then I sold half a Bitcoin. If I know that half a Bitcoin came from wallet B from the 2 Bitcoin, then I have to attribute the cost connected to that 2 Bitcoin. If it came from the 1 Bitcoin, then it's got to be attributed to that 1 Bitcoin. But with cryptocurrency, what you can do is then you can buy them at separate times and bring them together. They can be in the same wallet. And then when I take out some Bitcoin out of that wallet, you can't exactly necessarily say, but it was this Bitcoin or is it Bitcoin? We're not too sure. So the tax law sort of gives a bit of flexibility and says, as long as you've got all those records and all those costs involved, what you can do is you're allowed to pick the disposal method that's sort of most advantageous to yourself, which is fantastic. It means you can optimize your tax to get rid of it. So what this means is that a lot of people know about FIFO, first in, first out. They might know about LIFO, last in, first out. Might know about highest cost first out, or lowest cost first out, et cetera, et cetera, et cetera. All these different methods. Sort of the tax law is saying, yeah, you can use whichever method works for you. You can't really use the average cost method. That's not really allowed. But the other ones you can. You can pick and choose throughout there. But ordinarily, most people won't be doing that. They'd be relying upon some software, or they're relying upon us as the professionals to work through that and optimize these outcomes for you. And later on, I will talk about why a lot of the softwares out there actually don't optimize this to any great extent and can cause a bit of issues there. So disposals, capital gains and losses, disposal methods to choose from give a bit of flexibility. The capital gains tax discount. This is a huge one, really important one to understand. And later on in this course, we will run through revenue versus capital gains and whether or not you can qualify for the capital gains discount. But for now, let's just assume that you can qualify for the capital gains tax discount. What is this? It is that when you make a gain, after applying any losses, the gain, if it was made from owning an asset for more than 12 months from owning that asset, and you make a gain, 50% of that gain tax-free. Tax-free, people, that's fantastic. Can't beat that, tax-free. And then the other 50% of the gain is taxable at your marginal tax rate. So say if you were earning, I don't know, $130,000 of income, the marginal tax rate for the next 10 grand was 39 cents in the dollar, for example, and you made a 20 grand discountable gain, then you go, okay, half of that, 10 grand, tax-free, the other 10 grand, I put it on top of my tax, my other taxable income gets taxed at 39 cents on the dollar. So Another sort of way to look at it is you go your marginal tax rate, divide that in half, and that's your effective tax rate over the whole gain. So that in that example, just under 20% tax rate on your gain, which is in Australia, a pretty low tax rate. So a great outcome there. So I suppose the important thing really here in terms of the capital gains discount is you have to own that asset for more than 12 months. Very important. If it's 12 months or less, you can't get that discount. And it's applied after losses. So if I make a $1,000 gain and then I have a $100 loss, I don't get to go $1,000 gain, divide that in half, it's $500, then take off the loss and only pay tax on $400. Fortunately, that's not the way it works. What I have to do is go $1,000 minus the 100. So now I have 900, then divide that in half. So I've got to pay tax on 450. So losses get applied first, whether they're losses from this year or a previous year that have been carried forward. They get applied first, and then you apply the discount. One extra thing to, I suppose, point out here is you might have gains that are from longer term holdings that are more than 12 months. You might have gains from holdings that were 12 months or less. You might have some losses. You do get to use the losses against the shorter term gains first before the longer term gains. So you get a bit of advantage there if available. So I suppose in cryptocurrency, it's hugely volatile. You know, prices go up dramatically, prices go down dramatically. It's happened in the past, most likely going to continue to happen at various stages into the future. So a really important thing to recognize here is, and I'm just going to bring up a pen, is that, let me see if this is working. Yep, there we go. Okay, so over the tax years, big spike in crypto prices and then they come down. Okay, now what might happen is we get different tax years. Okay, so gains and losses that are made defined by and declared in your tax return depending on the tax year. So in an earlier tax year, prices going up and up and up, you might make quite a large gain. Okay, so you make a realized gain. So realized gains were only those where it was a disposal. If it's a gain but you haven't had a disposal event, you don't have to worry about them. So it's only when you've disposed. So you might make a big gain. Those prices come down, we've flipped over to a new tax year, and we've got a loss in that subsequent tax year. Now, unfortunately, in this scenario, what it means is this loss that was made over in the later year, you can't use that loss to reduce this early year gain, which can have quite dramatic impact with people in crypto, where what they do is they oftentimes make quite a number of gains early on. These gains are then subsequently held in crypto, basically repurchase other crypto, and then those cryptos dramatically reduce in value. Fortunately, that means we're still going to pay tax on this big gain that we've got over here. And then if those cryptos subsequently lose value, you could be in the awkward situation where the value of your crypto might even not be enough to pay the tax, which is a real big risk to be aware of and to fully understand. So losses made in later years can't be used to offset gains from an earlier year. So extremely important to recognize that. Okay, so that basically covers those very simple basics.